Alright, what's going on everyone? Welcome back to my channel. It's called Investing Sucks, and we like to talk about the part of investing that sucks. So today I'm going to be doing a video on Chipotle, and the reason for this is because they've been in the news recently. They had that minimum wage hike where they're hiking their minimum wages by about 25%. They're also raising their menu prices. But beyond that, I think this is kind of a good example of a company that has a lot of optimism around it, and as a result of that is showing a very high valuation in their stock. So it's a good thing to kind of look at a bit more in depth, see if we can explain their current stock valuation, see what kind of value it gives to investors. And what I'll be doing is kind of just going over basic fundamentals like I always do, and using a multiple of earnings method to kind of project what their valuation could be in the future given certain basic assumptions. This will be a super simple video. It's not going to be a detailed financial model. So we'll get right into it. But before I get into that...
Dude, just stop for a second. Have you tried their burritos?
Yeah, I have.
So you've had their burritos, but you still haven't invested in them.
Well, yeah, but just because their burritos are good doesn't mean their stock price is at a good valuation.
Hey. Burritos, man. That's all you gotta know, man. That's all the research you gotta do. Just eat their burritos, you're good to go, brother. Hey, I'm about to head over to Chipotle right now. Do you want me to get you something?
Oh, yeah, sure, I'll take something. Could you get me a beef bowl?
For sure, man. Coming right up.
Perfect, man. Thanks.
Hey, no problem, man. You know, just because we have different investing philosophies doesn't mean we can't get along as friends, you know?
You know what? You're absolutely right. And I thank you for that, sir.
Of course I'm right. Alright, I'm out, man. I'll see you in a bit, alright? I'll come back with your burrito.
Okay, well, anyways, we'll get back to the video, guys. But before I get into everything, if you are new to my channel, I'd really appreciate if you would consider subscribing to my channel if you do like this type of content. My goal is to hit 100 subscribers by the end of this year, and I'd really appreciate if you'd help me reach that goal. But without further ado, let's get into the video. So I'm just going to go over some basic fundamentals, just to give you a high-level summary of what's going on in this company kind of throughout the last few years. So if we start at the top, we'll start with the income statement from 2016 to 2020. So as we can see, they have pretty significant revenue growth. So revenue growth on a compound basis has been just under 9%. Now, this is a little bit skewed because their sales did drop a bit in the year 2020. It didn't grow as much as it probably would have if the pandemic hadn't happened. And then profit growth, as we can see from these 5 years here, this is a little bit skewed. 2016 was kind of an oddball year for Chipotle. If you compare them to 2015, their revenue and their earnings in that year were much higher than it was in 2016. But overall, it's showing a compound annual growth rate of 73%. That obviously is a bit high, but we want to keep things consistent, look at things on a 5-year basis, and that's what the data shows. Now, their net profit margin, this is something that's extremely important to restaurant businesses such as Chipotle. Now, Chipotle, they only have corporate-owned stores. They don't use a franchise model, so their net profit margin isn't going to be quite as high if you're comparing them to McDonald's or whatever. So 2016, it was very small, below 1%. Again, that was kind of an oddball year for them. It's much higher in 2020, but they released their Q1 2021 results, and their net profit margin was actually significantly higher. It was above 7%. So you can kind of see why there's a lot of enthusiasm towards this company, because they do have improving margins. They're opening plenty of new stores. There is a bit of sales growth in their stores. It's not huge, though. Now, if we move on to the balance sheet, just to get an overall snapshot of how financially strong this company is, they have almost $700 million in cash and about $360 million in investments, which is really just idle cash that they're investing. Total current assets is $1.4 billion. Total current liabilities is $800 million, so they have a current ratio of 1.75. Now, this is quite strong. It's not, astronomical like some companies that receive a lot of funding. But with this company, it is quite strong. You want to see at least a current ratio of 1. Ideally, 2 would be best, but 1.75 isn't bad. And to put this into comparison, Starbucks has a current ratio of 1.07. So it is overall pretty good. And then total liabilities of just over $4 billion. Debt to equity ratio is 2, which is slightly high. I wouldn't worry about this too much though, because a lot of that debt to equity ratio comes from long-term lease liabilities, which they are required to report as for international financial reporting standards. So they do have an offsetting right of use asset that they recognize along with those lease obligations. So financial health overall, judging from the balance sheet, is quite strong. Now, if we move on over here, we can look at cash flow. And we want to see free cash flow growing, which it clearly has. In 2016, it was about $90 million, now just under $300 million. So compound annual growth rate of 26.3% over the past 5 years for free cash flow. So they're clearly growing, right? Not just in revenue and profit, but also in free cash flow, which as investors is what you want to see. And those shares are actually decreasing. They are actually actively buying back their shares. It went from 29 million shares in 2016, and now we're just under 28 million. So not a huge decrease in there, but it is good to see as a long-term investor in this company, they are on your side. Now, there is a question of whether or not it's smart to be buying back their shares if their valuation is so high currently. So clearly, Chipotle management thinks that their valuation isn't too high, otherwise they wouldn't be buying back their shares. So they are on the side of the investors. That's a good thing. So what we've seen so far is quite good. And then quality of earnings is something I personally love to look at. All it is really is just comparing their cash flow from operations to their net income. And you don't want to see a huge disparity here. So when we compare these, we get a ratio of 1.87, which is pretty good overall. Usually if you see something like net income positive and cash flow from operations negative, that would be a cause for concern. Not the case here. So fundamentals are pretty strong in this company. You can't deny that. Now, we're going to go to some qualitative factors. So I talked about the net profit margin before, and they had year-over-year sales growth from Q1 2021 to Q1 2020, and it was 23.4%. So sales are going up significantly. Obviously, that's expected because of last year being the pandemic and sales kind of declining a bit, especially in the first quarter, because that was kind of, peak fear in the pandemic. And then minimum wage, so that's another big thing that's going on. So their wage costs are going to go up rather significantly. They are offsetting this by about a 4% increase in prices, which I think a lot of people are optimistic about, but their wage costs as a percent of their revenue in previous years was hovering around 26 to 27%. So it is a very big cost for them, which makes sense for pretty much any restaurant business. Wage costs are going to make up a significant portion of that. And if before they're going up to $15, before say if it was $12, I mean that alone is a 25% increase in one of their biggest cost items. So that is something to be concerned about. But they are raising their prices and their sales overall are going up. Now there's also a question that relates to their online orders, because as we know, online orders, as expected last year, were up quite a bit because of that thing that happened. But when you see online orders, there's always a question of, will it cannibalize sales? So is it just redirecting sales online that would have occurred in the store? Or is it actually, fueling further growth? Is it going to allow them to expand to new customers? So the way you can kind of look at that is you could look at same store sales growth and see, well, this would be my interpretation of it. If so you have same store sales growth, and if digital orders, so they were 10.9% in 2019, they went up to 46.2% in 2020. If that is a real catalyst of growth, you should also see same store sales growth. Not like to a similar proportion, but you would want to see growth there. And while it did increase, it didn't increase that drastically. It went up about 0.8%. So in 2020, it was about 2.223 million. And then the previous year, 2.205 million. So it is an increase. And this is same store sales for stores that have been in operation for at least as 12 months, I believe it said. So it is an increase, but to me, that kind of says that the online orders aren't really a major catalyst of growth. That could be interpreted differently in some ways, but that's just my intuition. Again, you can disagree with me, but that's just kind of how I feel. So now we're going to go over here, and we'll talk about this valuation method. So I'm going to zoom out a bit here. Okay, so now we'll get into the earnings model here. So these here are my three inputs. I've kept it super simple. So the first one is just revenue compound annual growth rate, and it'll be over 5 years. So, and then we also have net profit margin. So what will their net profit margin be 5 years into the future? And then a price to earnings ratio. So in the year 2025, based on how much the revenue will grow, what their net profit margin will be, what their PE ratio we could suspect to be at that point, and then compare that to their stock market valuation today. How much of an annual return could we get if we hold them from now, which is I guess 2021, halfway through 2021 into 2025. So I'm going to zoom in this model and show it to you guys now. Okay, so here I've got my earnings model here. So it's just a basic multiple of earnings model, and I have three key inputs, as I said: the revenue compound annual growth rate, the net profit margin, and then the price to earnings ratio that we could expect in the year 2025. So it's projecting their earnings and revenue out for the next 5 years. So if we assume revenue grows at 20% each year for the next 5 years, so until 2025, we get about just under 15 billion revenue. And then if we assume an 8% net profit margin, which is currently higher than what they're achieving right now, we could expect this to grow as they are probably going to raise their prices. So we'll go with 8%. Again, we're just kind of trying to use assumptions here to see what assumptions we need to happen in order for this valuation to make some sense. So that gives them a profit of just under 1.2 billion. If we assume a 30 PE multiple, then their projected valuation is about 35 billion. Now their valuation today is 38 billion. So this would give you an average annualized return over that 5 period of negative 4.16%, which is obviously not what you want. It's a negative return. Now, because we are investing in an individual company and a growth company nonetheless, or what we'd expect to be a growth company based on their price to earnings multiple, you want a higher rate of return, even higher than what you'd expect on the general stock market. So you'd want, I'd say, at least 12%, probably closer to 15%, especially because when you're investing in these growth style companies, as much you can call a restaurant business a growth company, you're taking on that unsystematic risk, right? If you're investing in an individual company, you want to see a high return, you expect a higher return. So let's do some tests, see what kinds of numbers we need to put in to get, see if we can get a 12% average annualized return over the next 5 years, and then we can kind of determine if those assumptions are reasonable. So let's assume their net profit margin goes to 10%, right? I don't know how, I don't know why, but let's just assume it goes to 10%. And there are a lot of people, analysts who expect that to happen, right? And the net profit margin is after all expenses, all operating expenses, taxes, interest, everything. So that means revenue divided by net income is going to be 10%. So I'll make that change. Okay, so 10%. Now just with that, our average annualized return goes up to 3.03%, which is good, right? It's not negative anymore. But again, we want to see at least 12%, probably closer to 15%, because of that unsystematic risk we're taking on by investing in an individual growth style company, right? So let's say their 2025 PE ratio is a bit higher. We'll call it 40. So we change that to 40 and we can see the return gets a lot more attractive very quickly. We're already at 9%. But a 40 PE multiple, after they have 5 years of growing 20% every single year, there's questions as to whether or not that's actually reasonable, right? Because historically, PE ratios range somewhere into the 10 to 20 range for larger S&P 500 companies, usually a bit higher in that range, more like 15 to 20. So anything above 20 is considered a growth company, right? So if they're at 40, that's still a company that has significant growth priced into their valuation. So you can see 9.3% here. Their projected valuation in 2025 would be just under $60 billion compared to the current valuation now, which is about $38.5 billion. So we got to make these projections a bit more aggressive. So let's say their revenue growth goes to 25%. Now we're kind of in the area where this investment makes more sense. So we can see 13.68% here. So their projected valuation in 2025 will be $73 billion compared to what it is now of $38 billion. So if these assumptions come true that we have here, these very, very basic assumptions, then yeah, it makes sense to invest in them at their current valuation. But you have to ask yourself the question, is it reasonable? Is it reasonable to think that Chipotle can grow 25% a year? Is it reasonable to think that their net profit margin can go to 10%? Kids, keep in mind, net profit margin is after deducting all expenses, operating expenses, taxes, interest, everything. And after all of that, they still have a 40 PE multiple in 2025. Now, if you're convinced in this and you believe in the company and these seem like reasonable assumptions to you, then invest in them. I mean, it makes sense at this valuation, but you really have to ask yourself, and this is the case with all growth companies, this is the kind of logic you have to apply to these and say, okay, their valuation today is this. Under what assumptions does it make sense to invest in them? Because you have to know what type of risk you're being compensated for. Like I said before, it doesn't really make sense to invest in a company, an individual company, if your expected return is only below 10%, because the stock market averages about 10% a year. So anyways, that's just a basic earnings multiple method. Again, maybe I'm missing something here. If you're watching this video and you're invested in Chipotle for the long run, I hope you got in earlier and you're doing pretty well. But if you are invested in them and you still think they're a good valuation, then seriously, I'd appreciate an explanation. I mean, I'm really interested to see what other people see in this company. Obviously, I'm assuming it has a lot to do with growth, so opening new stores, increasing same-store sales growth. But yeah, let me know your thoughts. And thanks for watching this video. I really appreciate you sticking around, and I'll see you in the next one.